Howdy, everybody. Welcome to the Liberty Call. Today is Friday, August 2nd, 2024. Hope you're having a fantastical day out there in the interwebs. What an ugly day in the market. I mean, completely shocking. I mean, it was down yesterday, and my comment at the beginning of the broadcast was, why is everyone in such a bad mood with the markets? I mean, you basically got telegraphed by Chairman Powell that, they're going to probably lower rates at some point here in the near future. So why is everyone panicking? I mean, was that the sign that, we better, they're actually going to start lowering rates? They must see something that's negative in the data. So I don't know. All right. Well, if it is your first time watching the Liberty Call, if you could do me a favor, give me some thumbs up, a like, share, subscribe, follow, and press that notification bell. All right. Let's get into today's numbers. Dow Jones was down 1.51%, 610 points, closed at 39,737. S&P 500 down 1.85%, closed at 53.45. NASDAQ down 2.45%, 420 points, closed at 16,737. And if I could pause here, the last few weeks we've had a situation where when people have been moving, or they call it sector rotation. But people have basically been moving from more your speculative investments, your growth stocks, things like that, to your blue chips, like your Dow 30, your big companies that typically pay dividends. They're not real sexy. They don't jump around a lot, but, they're fairly stable. And at this point, the people jumping out of, you can see that right here, NASDAQ had far more downward pressure today than the S&P 500 and the Dow Jones. And, normally people would, take their money out of growth, put it into value. It appears that even that, they may be going to value, but then the people in the value are jumping off and probably going to fixed income and other asset classes at this point. So it is a little interesting that, if you wanted to stay in equities, there's not as many places to hide at this point. All right, let's get back into the numbers. The VIX was up 26.68% today. It's at 23.55. Canada down 2.18, Brazil down 1.27, and Mexico down 0.35. All right, going to Europe, Germany down 2.44, the UK down 1.31, France down 1.61, Netherlands down 3.11. Spain down 1.67, Italy down 2.55, Switzerland down 3.73, and Portugal down 1.06. So it's red across the board in Europe. In the Russian markets, the MOEX was down 1.25, RTSI down 1.16. And the overnights, the Nikkei in Japan was down 5.73%, Australia down 2.11, New Zealand down 0.72. In China, the Shanghai was down 0.92, the Shenzhen Component down 1.38, China A50 down 0.82, DJ Shanghai down 0.99, Hang Seng down 2.08, and the Taiwan weighted down 4.43%. So if we just look across the day, is there a green anywhere? I mean, well, the VIX. So if you were investing in the VIX, you might have made some profits today. All right. So that is about it. So, all righty. So kind of an ugly day across the globe. All right. Let's jump over to the weekly chart and bring that up. So let's go to 1 week. Starting out on the 29th. Is that the 29th? Yep. All right. So the 29th. And so for this is the Dow Jones is going to finish the week off down 1.96. The S&P 500 down 2.65. The NASDAQ, I imagine, is going to be beat up pretty good, down 4.14%. The Dow Utilities finished the week up 4.59, and the Dow Transports down 3.14. So other than the Dow Utilities, everything else of the major and semi-major indexes was ugly today. So let's back out and look at the longer-term trend. Let me put my lines back on here. So like we can see here, we had this upward trend from November of last year. We've been in a downward trend most of the second half of last year. It changed course and then kind of stalled, broke through the trend line in February-ish, and pretty much been trading sideways. We did get a little bit of an upward trend again here starting in April, but looks like it might be headed towards breaking through again. The SP 500 is a better chart to look at. So again, downward trend second half of last year, upward trend began October, November, broke through the trend probably April-ish, and then had another uptrend that began late April, and it broke it on about the 18th of July, so about 2 weeks ago. So it's been trending down. We're going to probably zoom in here and add some trend lines to see when it breaks through again, but who knows. All right, so like I said, the Dow, that's the SP 500, NASDAQ, and the SP 500 charts look very, very similar, at least over the last year and a half. So, all right, so those are the charts and the markets. So let's go ahead and move over to the economic data that came out this week. Initial jobless claims came in at 249,000. Forecast was 236. The previous number was 235. Continuing claims came in at 1.877 million. Forecast was 1.86. Previous number 1.844. The consumer confidence gauge came in at 100.3. Forecast was 99.7. The previous number was 97.8. So a little bit of a tick up there on that particular chart. The Case-Shiller home price index came in at 6.8%. Forecast was 6.5. Previous number was 7.3. So is trending down a little bit over the last couple of months. Let's see, on a month-on-month basis, grew by 1%, and the previous number was 1.4. The job openings and labor turnover survey, the JOLTs report, showed that there were 8.184 million jobs out there open on the market. Forecast was 8.020, and the previous number was 8.230 million. So fairly similar to last month, not a huge difference. All right, the ADP non-farm employment change grew by 122,000. Forecast was 147. Previous number was 155. Pending home sales month over month grew by 4.8%. Forecast was only 1.4, and the previous number was a contraction of 1.9. The ISM Manufacturing Purchasing Managers Index came in at a 46.8, just slightly below the forecast of 48.8. And the previous number was 48.5. Non-farm productivity quarter over quarter grew at 2.3%. Forecast was 1.7. Previous number was a 0.4. And unit labor costs quarter over quarter grew by 0.9. Forecast was 1.8. Previous number was 3.8. And non-farm payrolls grew at 114,000. Forecast was 176. Previous number was 179. And the labor participation rate popped up to 62.7. Forecast was 62.6. And the previous number was 62.6. The unemployment rate came in at 4.3%. Forecast was 4.1. Previous number was also 4.1. And to wrap things up, total vehicle sales came in at 15.8 million. We got one more chart after this. Previous number was 15.3 million. And lastly, factory orders contracted at 3.3%. Forecast was a contraction of 2.7. Last month's number was a contraction of 0.5. All right, so that was a lot of data that was on the docket this week. So it's not terrible, kind of like we talked about the other day. The fact that it's more of the reports that are more, they're not at the macro level. When you dig in more on the micro level, the 1,000-foot view of things, there's a lot of trends that have been in contraction territory for, a year or two. Like I mentioned yesterday, the yield curve has been inverted for 2 years. And just a general malaise. I mean, I only see a small fraction of the country in my little part of the world, and the people I keep in touch with that are across the country. So, All right, let's get into the market recap. U.S. stocks slump as weak job data flag recession worry. Everybody's worried about recession. U.S. stocks experienced a significant decline on Friday as weaker than expected jobs report stoked fears of an impending recession, leading to a sharp increase in market volatility. The July jobs report revealed that non-farm payrolls increased by only 114,000, the lowest since January of 21, and well below the expected 177,000. The previous month's payrolls were also revised down to 179,000. Additionally, the unemployment rate rose to 4.3 from 4.1, and a month-on-month average hourly wage growth dropped by 0.2 from 0.3. Analysts at Capital and Economics suggested that this sharp slowdown makes a September rate cut inevitable, with speculation of a 50 basis point cut or even an inter-meeting move. I would only suspect that if, the wheels were coming off the track of the, the Texas cyclone, and that people were in real danger. I don't think they'll do an intra-meeting anything because. Let's see. The next meeting is September 18th and 17th and 18th. And then after that, it's November 6th and 7th. So it's about 6 weeks it's about 6 weeks between each meeting. So I wouldn't venture a guess that they would do that. Consequently, JP Morgan and Citi called for back-to-back 50 basis point cuts in September and November, with JP Morgan suggesting a strong case for the Fed to act before the September 18th meeting. Market reaction, the CBOE volatility index, easy for me to say, or fear index jumped to 26.21, the highest level since March of 23, indicating increased market anxiety. Additionally, the yield on the 10-year treasuries dropped 151 basis points to 3.824%, reflecting economic concerns. And for those of you who haven't heard me talk about this, the way I look at the VIX or the fear index or the whatever you want to call it, it's the way I kind of look at it is anything under 20 is kind of normal circumstances. So if you were to equate it to a traffic light, it's a green light, you're probably okay. 20 to 30 is kind of your yellow light. It's be careful, proceed with caution if you're gonna, either hit the gas or hit the brakes. One or the other. And above 30, I view that as your red light. And stop, look both ways. If there's no traffic coming, proceed on your own. At your own risk. So, all right. Jumping back in, tech sector is under pressure. Tech giants Amazon and Intel reported weaker quarterly results, exacerbating market pressures. Intel's stock plummeted over 27% after missing earnings estimates. When I was looking through the indexes, Intel was one of the worst on the day across the S&P 500 and NASDAQ. Suspending its dividend and announcing a 15% job cut as part of a turnaround plan. UBS cut its price target on Intel, citing ongoing financial weaknesses. Amazon stock fell more than 8% due to a softer than expected revenue outlook and warnings of slowing online sales as consumer caution grows, despite a better than feared AWS results, which is Amazon Web Services, I believe. Misses in ads, North American margins, and a disappointing guidance weighed on the stock. Apple outperforms. In contrast, Apple saw its stock rise 2% after reporting stronger than expected revenue and profit for the June quarter, or the quarter that ended in June. Despite a slight decline in device sales from the previous year due to increased competition in China, sales of its flagship iPhone slightly exceeded expectations. So in summary, the weaker jobs report has highlighted recession fears and market volatility with significant impacts on the tech sector, while Apple provided a rare positive note amid the broader market decline. Wow. So it's almost a little bit endearing. We're watching the Fed, trying to fix the economy after their brilliant monetary policies, which set the stage for this ginormous mess that we're dealing with. So, nothing says confidence like, calling for massive rate cuts while claiming everything is under control. It's insane. So perhaps the next they'll suggest printing more money to solve the debt problem. I mean, wouldn't that make more sense? Why don't we just open the spigots and print more? Oh, wait, that is what caused this, what we're dealing with right now. So, awesome to have central planning in our government. So next up, let's get to the July employment report from First Trust. This was put together by Robert Stein, Deputy Chief Economist. All right. The labor market weakened significantly in July, raising concerns about potential recession. Non-farm payrolls increased by just 114,000, falling short of the expected 175,000, with previous month's gains revised down by 29,000. Excluding government, education, and health services and leisure and hospitality sectors, core payrolls rose by only 17,000, the smallest gain this year. Civilian employment, which includes small business startups, increased by a mere 67,000 in July and only 57,000 over the past year. This stagnation contrasts sharply with the part-time employment, which rose by 550,000, while full-time employment decreased by almost 500,000. The labor force grew by 420,000, leading to an increase in the employment rate to 4.3%, up 0.4 percentage points from 3 months ago. This rise in the jobless rate has historically been associated with recessions, though not always. Key indicators within the report were also concerning. Total hours worked fell by 0.3% in July, and average hourly earnings increased by only 0.2%. Over the last year, hourly wages have risen by just 3.6%, barely outpacing inflation. Given the developments, the Federal Reserve is likely to interpret this data as a signal to start cutting short-term interest rates in September. The M2 money supply measure, which declined from early 22 to late 23, appears to be causing economic pain as the effects of tightened monetary policy begin to manifest. I mean, they raised the money supply from like 16 or 17 trillion up to like 21 trillion, and they've taken it down like 1 trillion. So, yes, it's going down, but it's not like we're back to the same money supply that we were at in going into 2020. Excuse me. In summary, the weaker job growth, rising unemployment rate, and modest wage increases indicate a softening labor market. This scenario sets the stage for the Federal Reserve to consider cutting rates as the economic slowdown becomes even more evident. All right. Yeah, it is. It's heartwarming to see, the government's heavy-handedness and the tinkering that's, been going on. After all, who would want to trade full-time employment for a part-time gig where you just barely, get past inflation? I mean, it's just, it's nuts. All right. One last bit of news here. This comes from Zero Hedge. It's titled Car Repos Rise 23% year over year. And that is not a good, having lived a decade in the collections and recovery side of the financial world, when your delinquencies and your repossessions start to go up, it typically is a sign of, something negative on the horizon. The private debt crisis in America is intensifying, with car repossessions surging 23% in the first half of the year, according to Martin Armstrong via ArmstrongEconomics.com. An estimated 1.6 million Americans are expected to lose their vehicles to repossession by the end of the year, up from 1.5 million in 2023 and 1.1 million in 2021. The rising cost of cars, fueled by inflation, interest rate hikes, and supply chain issues, has made new vehicles unaffordable for many. Car dealerships are struggling despite a 36% increase in inventory this year, as the average list price of new cars reaches $49,096. New cars now sit on lots an average of 65 days, a 41% increase from the previous year. Financial illiteracy is a significant factor, with many Americans unable to accurately assess their affordability. The average loan for new vehicles is $40,634 and $26,073 for used cars, contributing to auto loans making up 9.2% of all consumer debt. Monthly payments average $735 for new cars and $523 for used ones. A viral story from April highlighted this issue, featuring a woman who bought a Chevy Tahoe for $80,000. Her husband had purchased a GMC Sierra 1500 AT4 for $78,000 at a 14% interest rate, resulting in a $1,600 monthly payment. The family's financial mismanagement underscores the broader trend of Americans overextending themselves on auto loans. Yeah, not just cars, houses, credit cards. Projections from Cox Automotive suggest that repossessions will rise to 1.7 million in 2025. As of Q1 24, U.S. household debt totals 1.77 trillion, including 12.44 trillion in mortgage debt and that number's not right. 1.7 trillion. That's probably billion. So, anyways. and 1.2 trillion in, maybe that was 1.7 added in Q1. That's probably what that is. So 1.62 trillion for auto loans, 1.12 trillion in credit card debt, and 543 billion in other debts. Major banks have reported significant losses in unrecoverable debt totaling 4.14 billion. Banks are aggressively reclaiming assets, sometimes after just one missed payment, worsening the financial strain on households already living paycheck to paycheck. Meanwhile, governmental policies pushing for electric vehicle adoption under the climate emergency banner are adding pressure, with no viable alternatives and high tariffs on cheaper imports from China. So, yeah, it's just wonderful. I mean, Americans are drowning in debt, and your government wants you to go trade in your perfectly working car, maybe even paid off for a electric car that who knows, how that's going to work out in the long term. I mean, because you got to replace the batteries every 8 to 10 years. I mean, that's a big money suck. And, just the maintenance, they're harder on the roads because they weigh a lot more. I mean, I guess if you drive 5 minutes to work and you can plug it in your garage every night, probably not the worst thing. Well, you probably shouldn't park it in your garage because of the fire danger. But anyways, if you have a 5-minute commute, it makes sense. But for someone like me who drives a truck, pulls heavy items with it, and am out in the middle of nowhere, diesel, I'll stick with it. So, all right. Well, that's everything that I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information's there. I hope everyone has a wonderful weekend out there, and I'll talk to you again on Monday, hopefully. Adios.